What's going on, everybody? This is Frank Chen with REIClub.com, your link to creative real estate. I'm excited that you guys are here today. We have a returning guest. You may recognize them from one of our previous recordings, but they're following up with us on one of their most recent deals. It's a huge one. It's an apartment complex, and they're going to talk about a lot of the details that went into how they acquired the property, how they negotiated the property, all the real important details that go into commercial real estate. So really happy that they're joining us today. Now, though, you may not know this is actually our third attempt. We've tried previously, and for some reason, these recordings are just not working out for us. But thankfully today, we have one of the pros with us. We're going to make it look super clean for you, and we're really excited to jump into the content. But before we do, I want to go ahead and bring on our awesome guests, Mr. Jake Barbaro, or Gino Barbaro, and Jake Stinziato. They're our special guests. I think Gino should be on our left over here, and Jake should be on my right over here. Go ahead and say hi, guys.
Hey, guys.
How's it going? Gino, we'll start with you. I know you are based out of Florida right now, correct?
Yep, I am in Florida. I actually was in New York. I retired out of my restaurant business after 20 years. March 1st, that was my get out of the rat race date. So I've been, I guess, retired for the last 4 or 5 months, but I've been pursuing this real estate education, and it's been awesome. We closed on a deal in March, and we're looking to buy another deal. So it's kept me busy, and I love it down in Florida. The reason why I came down here was actually I want to expand the portfolio down here, buying opportunities down here. That's where the real estate's really booming down here. So problem is when the real estate booms, prices boom. So Knoxville is still where we're based at. So that's why I'm down here.
So you purposely relocated from New York
Yep.
to a better market for your business, correct?
And that's what I'm doing. I always say it. It's about massive action. I've got 6 kids, so it's not an easy thing to relocate 6 kids in a family. So I don't want to hear anybody's excuse that it's too hard, or it is hard, because if it wasn't hard, people wouldn't be doing it. So my point in life is if you want to do something, make it a must and make it happen, as Jake likes to say. And that's what I'm trying to do. If I don't like it down here, I can always pick back up and go back up to New York. But at least I want to give it a try down here. Quality of life, the weather's better, I'm near the beach. It's just awesome.
That's the Make It Happen shirt that's waiting for you, Gino. I forgot to give it to you last time we were in Florida.
Where's mine at, Jake? You gonna send me one? I should.
If we get this one right, Frank, I promise I'll send you one. All right.
Fantastic. That'll be a reward. I appreciate that. Jake, tell me, you're based out of Tennessee right now, right? But you're originally from New York as well?
Originally from New York. Back in 2001, made a move just to get a better quality of life. It's better weather, more affordable down here, and we struck gold in multifamily investing and knocked out our first 25 units. I think it was beginning of 2012, and never looked back, and have just been knocking it out of the park ever since then. So
people know on the call, like, how long have you guys been partnered together doing deals?
We started the partnership maybe in 2010/11. It took us a good 18 months to get our first deal, and we were persistent about it, but we didn't let go. But once, Frank, the amazing thing in life is once you start doing something and you find a little success, you get that confidence going. Our first 25 units was and 25 units was not a lot for us. It wasn't small, it wasn't big, it was our comfort zone. I didn't want to get into singles, I didn't want to get into these large complexes. I wanted to get into something where we could afford the down payment, we had a little owner financing, and we were able to make that payment. So we got the down payment, we got enough capital, and we loved it. The first deal worked out great for us. So after that, 4 months later, we bought another deal. And then I would say another 6 months after that, we bought our third deal. And it just starts snowballing. If you get a little success and you get that recipe going where you figure it out, you can start putting a team together, you start building systems together, all of a sudden things can really just grow exponentially.
So, and that's what's exciting about today's call, everyone, is, we're discussing a very common topic with a group of investors who are in the growing stages. They've gone through the school of hard knocks. They've started to develop these systems in place, what they're going to share with you guys today, and they're still growing. So you guys are going to learn a lot of great stuff today. I think we're going to post some of the pictures of the property you're working with, some before and after, so you guys have a good idea of what it looks like, what they're working on, kind of where the efforts are going. Just so you guys have a good recap of kind of Jake and Gino's experience. Be sure to watch. I think we're going to put a video right over here of our first interview. It's kind of just like a basic layout of their commercial business, kind of the ideas and concepts you kind of should think if you're considering commercial real estate. Today's video is going to be more of the details of the actual deal itself and the nuances that go into owning commercial real estate and kind of how to scale it up, and we're going to get into those details as well. So with that, I'm really excited to get started. How about you guys?
Let's do it.
All right,
Let's
cool.
bring the pain.
Bring the pain. So we're going to have an outline that we're going to be going through. It's about a 3-page outline. I originally had it here. Let's see. Well, I can't find it around me now, but it's in front of me. And some of the checklists we're going to be going over, instead of going through each one in detail, it's going to take up quite a bit of time. We're going to include those documents, preferably right below the video, so you guys can download it, follow along. It'll be a lot more convenient for you, and we can cover a lot more important information on this end. So with that, let's go ahead and dive right on in. Let's talk about the deal, where it's located, how many units it is, and let's first talk about how you guys really found it and really negotiated down to the price you wanted. So let's do that.
Let me start off by saying it was not an easy deal. Every deal this size takes time. I mean, the amount of closing, it took us only 60 days to actually close the deal, but we had actually located this deal in August. We made a great relationship with the broker. We showed him our credibility book. We showed him the amount of property we owned, so he knew we were credible. We wanted to close in a deal. We loved the deal. Unfortunately, in August when we made it, it was called a call to offer, so we had to actually have people ahead of us bid higher than us. So we found out in October that we were out. There was 2 other guys that bid higher than us. And unfortunately, we're done. But I told Jake, let's just keep the relationship with the broker. He'd pepper him one day. The next day, I'd call him. So we were persistently being annoying, but annoying to the point of just trying to keep that relationship going. Fast forward, Thanksgiving weekend. He calls me up and says, the first deal, they went past their due diligence phase. So he goes, I think they might be falling out. So, and if I had never kept that relationship going, I probably wouldn't have gotten that phone call back. So fast forward to New Year's Eve. Nobody works on New Year's. Nobody works in the last 2 weeks during real estate. You must know that, Frank. We got a call. Guys, actually, there was a group ahead of us that fell out. The second group fell out. So they came to us and they said, listen, we had raised our price $100,000. So they said, listen, they want to do the closing. So we actually got contracts drawn up that week. January 11th, we got the contracts done. We closed on the deal 60 days later in March. So the time frame was huge. It was from August all the way to March. We were, it's a relentless thing. There were people ahead of us, but we were the credible group. We were the ones that wanted to do the closing. We showed that we wanted to do it, and once we put our mind, just got it done. And they were actually pretty amazed at the 60-day window. Once we had the financing locked in, we had all the relationship with the bankers, and that's the gist of it. Jake, you have anything to fill into that?
Well, yeah, there's a lot of moving parts there. I mean, we were, you got little old Jake and Gino here competing against a couple of real estate investment trusts. A lot of people hear the term REIT get thrown around. And what happened was they were bidding up the property quite a bit, but then they went back through and they tried retrading. And essentially what we mean by that is they maybe would have offered $8 million. And then when it came down to it, they did their inspection, they came back and said, well, how about 7.3 now or 7.2? And that really frustrated the sellers, and they had a history of this in the past, the 2 groups together. So when that group fell out, now everyone's getting frustrated. Things been dragging on since August. Now we're in June. Right now we're making this call in June of 2016. We closed in March, so this thing went on. It dragged on and on. And then the group behind them were saying, well, it's going to take us months to go in and do our due diligence, this, that, and the other thing. And we're sitting here just knocking on the door saying, look, we're closers. We get it done in less than 60 days. We go in. We're small. We're able to be very agile and just make it happen. And so that was really what we focused on, was just meeting their needs. They had a problem. They wanted to sell. They wanted to get out. So we focused on that and fulfilled their requirement. Even though we came in with a little bit less in price, we were able to get the deal done and get it done quickly, and that's what was important to them ultimately. And it was just hanging around there, being patient and persistent, and I always say patience, persistence, but willing to walk away. And we did walk away from it. Back in last summer when our price wasn't high enough, we came in with a price that we knew we could close on. And when that didn't work out because they took the higher offer, even though we were the group to get it done ultimately, we came with the price we could close on. We walked away from it. It came back to us because, look, they knew what the numbers were. The guys that put the offer in initially knew what the numbers were. They weren't going to pay that price initially. They knew what they were going to do. So it's about being ethical, being upfront about, and then you get a reputation for, doing the right thing, and it pays off, and it ultimately did for us.
Let me ask you guys, bring some clarification to those who don't know who to be working with on commercial deals. You guys aren't working with an agent, right? You guys are working with a commercial broker.
Correct. And we like to work directly with the brokers too. We don't like to bring in our own broker. We know what the numbers are. We underwrite our own deals. We don't want to bring in another party to speak for us because all it's going to do, it's going to not only dilute the listing broker's commission. We want that person to want to go with us because we're not going to dilute his commission. It's not a bad thing, right? And on top of that, the minute you tell a broker something, and then he goes and tells another broker, and then that broker tells the owner or the seller's assistant, and that assistant tells get as many of the people out of the equation, get to the decision maker or as close as you can, because everyone that's involved is just going to dilute your message or what you want to be relayed to the person you're ultimately dealing with.
Would you go ahead, Gino.
No, I'll say, Frankie, where do you find these guys? You go to real estate investment clubs. You go to, the REIA meetings. You go to a banker and say, listen, who's in the market? You go to LoopNet. Go on LoopNet. See who's listing most of these properties. I always say it's a Pareto law. 20% of the brokers have 80% of the deals. So you got to find those 20% of the guys out there and start making relationships with them. They're going to send you crappy deals. Analyze the crappy deals, tell them why they don't work, then they're going to start sending you better deals. They just want to know that you're a closer. They want to know, at the end of the day, they want to get paid. So if they can't waste their 6 months worth of time dealing with somebody who's not going to close, that probably pisses them off more than anything. I don't blame it, because when you got that signed contract, that money they have is already spent. So can you imagine taking that away from them? That's just something you don't do in this business. So I mean, come in with the right price, and obviously once you do your walkthrough, if there's something really bad, like a bad roof or something where you didn't see it, that's actually something that you can retrade on. But if you're asking for something like these guys were asking, they want to redo the kitchens. There's nothing wrong with the kitchens, but that's up to you. If you want to do it, that's something you can't ask for a concession for, because there's nothing wrong with the kitchens themselves. So that's one of the big mistakes that they made on this deal.
Right. So I know we didn't really discuss exactly, how many units are you guys, is this apartment we're talking about?
It's 156 units. There's actually 16 units were burned down. So we've got 16 units, just the foundations and a set of plans that we're going to rebuild. And there's 3 units on the property. We're going to talk about value adds. There's 3 units on the property that we're going to take the laundry units out of, consolidate them. So we're going to actually get another 3 units on this property, which is great. It's another $2,000 a month in income. Those are the value adds. That's what we're going to talk about in this call. That's really important. That's how you make money in this business, by getting those value adds.
Cool, yeah, and I know like we discussed it before, and they have you guys definitely want to stay tuned for that. They cover some really cool value adds, things they've done to modify the existing apartment, things they're adding in. I think Jake mentioned this dog park. You guys should definitely hear about that. He gets really excited about it.
Frank, you got the dog park picture?
I do have the dog. We're going to include that. We're going to definitely post it.
Nice.
I have 3 dogs myself, so I think, I know in Austin is where I live. I rent a lot of property, and I think they say that Austin's one of the most dog-friendly cities, and if you don't have that, amenity or that allow that, good luck renting out your property. So
that's the same thing with Knoxville, and we noticed that when we came in, a lot of people had pets, and Knoxville's known as one of those cities that's super dog-friendly. A lot of restaurants let you bring your dog out on the patio. A lot of the big box stores like Home Depot actually allow you to bring your pets in, and it's very common. It's just a very common thing around here, so we want to be accommodating to our folks' needs.
That's something important you guys are talking about. You guys are talking about something really important, knowing your tenants, knowing your client base. You have to know your client base where you live. I would even go so far as to say is try to hook up with a pet company, try to get discounts, try to get coupons from a pet company, and give it to your pet owners. That's one way to differentiate yourself and say, hey, listen, once you give a welcome packet saying here's 10% to a pet store, and you're getting the pet owner, that business, and you're also attracting that pet owner, and you get those fees. I mean, we charge nice pet fees, and unfortunately and fortunately, about 40 to 50% of the tenants out in the United States own pets. So if you're not allowing pets in your property, I can understand why you don't, but you're just getting a huge segment of that population that's you're not catering to.
That's a really good point. Yeah. So knowing your market, guys, is really important. It kind of tells you what you need to be doing to your property, to your investments, to really kind of make that extra spread. So let's talk about some of the due diligence you guys went into this deal. Obviously, we're talking about the financial aspects of it, the physical aspects where the add values are, and of course some of the legalities that you guys had to really pay attention to make sure nothing fell through the cracks. So let's talk about the repositioning of the property, right?
Before we get there, Frank, I just want to shed one little thing in, because I think a lot of times in today's society we forget the power of bartering. And if you, and seriously though, if you think about this, what Gino was talking about with the pet idea, if you're able to go into a local pet store that gets a lot of business and is close to your complex, you may say, let me advertise coupons, 10% off or whatever, so my tenants can go and I'll put them in all the welcome packets. If they start to see that and they label the coupons and they're coming in and you start to develop a relationship, Well, they may say, you know what? Do you have any flyers? Can you put some little those little fold-out thingy advertisements on our counter, and then you can start advertising as a pet-friendly apartment place. And then there'll be that synergy there where you can actually start to develop those relationships with businesses. To then, they're giving you a little marketing, you're giving them a little marketing, and everyone's winning. And I just think that sometimes in today's society, we put things too much in a box and we forget about those opportunities that may be right in front of us.
Oh, that's a great point, Jake. And I know, sometimes we're very linear. We follow a very set of rules. Kind of think outside the box. Especially now. We have a lot more hungrier investors, hungrier people who are creating these concepts, and these are essentially your competition. So if you create these one little extra small things, you really stand out quite a bit. I know one guy, he gives out I think food coupons when you sign up. And depending on where your income level is for your apartment, that could be a tremendous selling point. $200 in coupons, they may have gotten that for free just to help out a local grocery store or something. So fantastic ideas.
We've done that with Papa John's. I mean, another thing is if you have an A or B property, you might have a dry cleaner come out once a week, pick up everyone's dry cleaning, have them done it, and 2 days later, bring it back to everybody. So that could be a service to tenants. So you always have to think about your tenants as being your clients and how to serve them best. And just think about, businesses that can cater to them.
So quickly, you just mentioned something I want to bring up real quick. You said an A or B type property. Could you quickly go through how apartments are kind of defined or categorized and where your property lies on that list?
A properties are the highest level. They're white collar, they're new, within the last 5 years they're built, they have all the amenities, cafes, spas, clubhouses, fitness centers, they're the creme de la creme. Unfortunately, they don't cash flow, they appreciate really well. And that's what Jake was talking about REITs before. REITs love to own these because they're the shiny asset. They don't create wealth, they just maintain the wealth. You're just getting a simple 2 or 3 cap rate, not getting much money back, but they do appreciate. Now the B properties have a mixture of blue collar and white collar. They're between 10 and 30 years old. They're a little bit older. They don't have as many amenities, but that's what we like. We like the B and C's. So the C's are one step below that. They're 30 years old plus. I've heard them saying they're crap properties, but we love them because they cash flow like crazy, right? They have a lot of deferred maintenance. They need a little tender, loving care. They might be on the outskirts of town a little bit. They may not be in the path of progress or the emerging part of the city, but that's okay because they're great tenants. They probably will never buy a house. You treat them really well, they'll stay with you. And the D ones are, the war zone. We don't really tend to stay in those. They're lower income, maybe drug problems, so they're difficult. They got great cap rates, but I always say if you can't collect the rent, what's a cap rate if you can't collect the rent? And it's difficult. You can definitely make money in these properties, but we tend to stay away from them. We like to stay in the B and C's.
So cool, yeah, and that's the thing we're going to talk about later also in video is when Jake and Gino bought this property, how they transitioned from ownership, all the paperwork that went involved, getting in contact with the existing tenants, all those details we're going to be covering. So again, be sure to stay tuned. It's a lot of great info. So going into this, guys, just a real quick question for you. When you guys were approaching this property, obviously you visited the property. What specific things were you looking for? Was there a specific occupancy level, at least room to grow? The units were just right to where you only had to do maybe 1 or 2 things. What specifically were you guys looking for when you walked through? I know, Jake, you walked through the property, right?
Absolutely, yeah. The more vacancy to me sometimes, the better, because I'm going to pay what the property is currently doing, especially if it's in a good area. So I don't care or mind a high vacancy rate. I look at that as a lot of times an opportunity because based on the income that it's currently doing, that's what I'm going to pay on. So one of the keys to everything we do is we buy things based on actual numbers. So what the property is currently performing at, what the income currently is performing at, that's how we're going to put that in our underwriting, and that's how we're going to base our offers. So they definitely had some vacancies. They had some rubs plays. The ratio utility billing system wasn't maxed out, so they weren't maxing out the amount that they were billing the tenants back for water. And that's our framework goes like this. We go in, typically we'll fill the vacant units at market rents. These were close to market, so there wasn't a huge upside there, but there was a little play there. Then what we do is we look to maximize our ratio utility billing system, our RUBS penetration. So we try to make sure everyone's sharing in the water costs. And then what we'll do is after that's all done, it takes about a year, we go back through and then we raise the remaining renters to market rate. So there'll be people that were maybe down a little bit, we'll go through and raise them up, and then they'll go on a yearly annual rate increase of 3 to 5%, depending sort of what the market is doing. And so initially in this property, we've been in it for 90 days now. They're roughly averaging about $100,000 a month Last month we did 112. So we're already starting to see the increase from our repositioning process. And one of the biggest things was we renamed the property. It was called Sunflower Apartments. It was very dated. It was built in the 70s. But it was a beautiful, the property is beautiful. It looks like a theme park. There's paved trails going throughout it. It just needed a little TLC. What that TLC basically entailed was we're painting all the awnings. They had black awnings, but they were faded. They probably haven't been touched up in years. So we're doing that. We added this really great pool deck, and we took down the old fencing. It was just your typical old school ground fencing, putting in a black aluminum fencing. I sent over a picture, so you can hopefully put that up later, the new pool deck.
Yep.
Yeah, it elevates up a level. It's got louvered privacy siding. It's beautiful. So we did that. We added the dog park. We're adding the fitness center, revamping the clubhouse. And I don't want the listeners to get scared because we didn't really come out of pocket for any of this stuff. We were able to, by doing creative things at closing, get all that money back at closing in order to fund our operating account to pay for all of this stuff. But those are the little value adds that really made a difference. And the one thing I want to talk about is the name change. The property, it was a very reputable company that was operating the property, but it just had an old, stale kind of name to it. So we changed the name to the Hammond. We got this great new sign. I sent the sign over to you, and people are seeing change. And we striped the parking lot. They're seeing that things are being done, and they're really excited about it. So when we got it, I think we had 10 vacancies or something like that. We're down to 3 now, and we've seen that huge spike in our gross income per month. So things are really moving in the right direction. We're super excited about it.
So let's talk about that real quick. So you guys said one thing that probably really sparked a thought in people's minds, which was your cashback at closing. So when you guys acquired this property, can you guys go into a little bit of the details of kind of the finance that went into how you guys bought this property?
Well, let me backtrack 1 second real quick.
Yeah, sure. Go ahead, Gino.
Commercial and residential is, on commercial, you focus on the NOI, the net operating income. That's why you can make a ton of money on commercial, because if you focus on that and you raise it up, you can force the appreciation. When you buy a 3-bed, 2-bath house, you're basically comparing it to another one. You don't have the ability to do it as much with a smaller property. It's more market forces. What Jake is talking about, he just raised the NOI by 10, 12, whatever, from 100 to 112, $12,000 in 1 month. That's $140,000 a year. At a 10 cap, that's over $1 million in value. We just added, just by doing simple things, by forcing the appreciation. So that's the power of commercial. Now, if that's 156 is too big for you, bring it down to 15 units. It's still the same concept. You want to focus on the income and the expenses. That's what's great about commercial. And that's what we're doing. We're taking care of a lot of the fat that they had in the property, as far as phones, as far as garbage collection, as far as their payroll. A lot of the stuff was a little more bloated. We can run it a lot more leaner, and with this bill back, we can get more of that income up that way. So we're really focusing on the NOI with this property. And when we bought the property, we had bought it in the middle of the month. So when you buy a property mid-month, you talk about getting rents credited back to you. So we got half the month's rent. So that's 50 grand back at closing to us, credited to us. They had just signed the cable contract on the property, and they're great about it. They're a great company. They're great about it. They signed it like 2 months before we bought it. So it was a $50,000 cable contract that they signed in exclusivity. Well, who gets that? That comes over to us. So that's another $50,000 security deposit. So we're talking about a $150,000 nest egg we had. And what we ended up doing, this is learning from our trial and error. Before we bought the property, we earmarked that money for every specific project. So Jake went out. We had a team. We knew how much signs are going to cost. We know how much those 3 apartments in the laundry room are going to cost to consolidate. We know how much the fitness center is going to cost. We know how much the pool is going to cost. We know how much the dog park is going to cost. We're putting a barbecue pit in. So that all these repositions, all these value adds, we know exactly what they're going to cost. We budgeted it, and we had that money left over at closing. And if we have to come out of pocket for some of it, we'll just use the cash flow that we're generating. We're going to do it. But we want to reposition this property. And like Jake said, the third part is to get those rents up to market and above maybe. Well, now I think we'll have the ability to by the end of the year, because with all those amenities you have, you want to focus on those amenities that give you value. You don't want to put something in a second, or if you don't have any dogs, pet owners, what's a dog park going to do? It's not going to add any value. If you don't have people that use a pool or a fitness center, why put it in? But we think in the market, we're seeing what our competition is doing, so we're trying to mirror what our competition does, and from that, we think that's going to be able to increase our revenue, our income.
So see, there's a lot of millennials here. So this is the type of thing that the millennials, enjoy. A lot of the millennials in our complex have pets, like we talked about, and having a pool on site where they go mingle with each other, and the fitness center is definitely big.
Yeah, I think it's great that you guys, when it comes to making these type of decisions, where to put the money or even how to get the money, it's a lot easier when you do get cash back at closing. Essentially, it's your apartment paying for the betterment of your property. And I'm sure you guys, you guys have trainings and you teach people how to do this kind of stuff, right?
Mhm.
Right.
Sure.
Okay.
And the other thing, Frank, another way you can do it is something called a repair allowance. We didn't use it on this property because we didn't need to, but banks give up to 3% repair allowance or credit at closing. So let's say, for argument's sake, this property was $7 million. We could have asked for a 1% repair allowance, which would have been $70,000. So what you do is you tell the seller to make the price $7,070,000, and at closing to credit you back $70,000. So it's a net. So you get $70,000 credit cash, and the property owner gets a $7 million price. Now, why do banks want to do this? Well, where are you going to put that money? You're putting that money right back into the asset. You're going to tell the bank, listen, I'm using this money to fix the problem. And why wouldn't the bank love that? Banks like that because you're securing their asset, basically. So that's definitely a strategy that you can employ by getting money back at closing.
So let me ask you, we touched on, like Jake earlier, about like vacancies and how you guys, how you don't really feel that as a huge factor. With that being said, the current property you guys you guys bought, what was that vacancy level, and what did you guys do to kind of fill those vacancies? And of course, are the prices for the vacancies the same as the current tenants, or are there's a price difference? And how did you guys get those? How do you get them to match?
No, I got your question. Yeah.
Yeah.
So first, let's start with the market rates, right? So it's key to determine what your market rate is going to be. There's software out there that basically will scan all the 5-mile radius around and pull all the stuff that's listed online, square footage, and determine what your rent should be, but it's fairly expensive. We have the ability to do this ourselves without having to pay for the software. Part of the problem is that your leasing agents, someone will call in and they'll have to always check, I'm not sure what the price is today. But if we're within $5 or $10 and we're adjusting that on a monthly basis, we're going to be right there. So we're just very attuned to that. We look at that very closely. We use a few sources. We use Renometer. It's rentometer.com, and that's a free service. And they're essentially doing the same thing. What they do is you put in your zip code, you put in the amount of beds, and they'll pull everything in that area, and they're going to give you a gauge with a line, and it's going to show you either in good range or you're expensive or you're low. So you can use that to determine your market rent. You can go on and look at the different advertising that's online from your competition, start to gauge what they're renting out at, and then come up with what you feel is going to be fair, and the market will determine it. If you're filling up and you have a wait list, that's a red flag that your price is too low. Okay, so we bumped it up since what the current tenants are paying. We're probably up about $25 per unit, and then about $10 extra per RUBS because they were under marketing and selling their RUB service. So we've probably about $35 up per unit right now on the new leases that we've done. Plus, we're filling up the vacant units that were there when we took over.
So, Frank, a couple of things we did, though. We actually create a website. These guys, their website wasn't so great. We're in the process of really a kick-ass website with pictures and with information. We created a Facebook page. So what happens is you want inbound marketing. You want to be able to get marketing information out about your property. So Facebook's a great way to do that. We use rent links, apartments.com. We started with them. They're great. They're a great resource. You want to get as much information on your property, especially the first couple months, and you want to get that buzz going. And once you get that buzz going, we use a tenant referral policy where tenants refer, we give them cash back. So there's a lot of little cool things you can do to get that occupancy up.
So you guys have mentioned this thing called RUBS quite a few times. I know that this is your way to kind of streamline your utilities, kind of flatten out the cash flow, kind of figure out how these numbers work. Could you explain a little bit more about what RUBS is and kind of how you implement this into your apartments?
Yes. Yeah, we implement the RUBS ourselves. You can't bill back for more than what the property's doing, so we always make sure we're at least 5% less than what the utilities actually are. The units are individually metered for electric, so it's pretty much a water, sewer, and garbage fee. So we look at what that fee is, and we have like a 12-month rolling. We get an average, we less it by 5%, and then we bill the tenants back for that on a flat rate monthly basis. It may fluctuate from the 1 beds to the 2 beds as long as we're kind of hitting that number. If you want to simplify it, though, and especially in the beginning, you can go to a company called NWP. It's nwp.com. They'll actually do that for you. They'll charge a service fee, I think, of $2 to $3 to the tenants, so you're not actually paying for it, but they'll actually take the guesswork out of it and do it for you. If that's something you'd like to do, they'll help you out with that.
And do you guys feel like a RUBS program is kind of like not mandatory but essential to apartments? Do you feel like all apartment owners should implement this?
It's part of our framework. You know, it's really that's how we drive income on our properties. So it's the second step to our repositioning framework. So everybody can has sometimes their own way. It's essential to our business plan to achieve our goals.
Frank, it's important to know that if the market's doing it. Fortunately for us, Knoxville, everyone does it. I mean, all the apartment owners, the majority of them do it. So the guys that don't do it are either too lazy, they've either owned these properties for 20 years and never changed, or they just think that the tenant's going to leave if they do it. So it's really important to see what your competition is doing. Fortunately for us, the competition is doing it. And the other fantastic benefit about it is when somebody knows subconsciously that they're paying for water, even if it's sub-metered, all of a sudden the usage goes down by, they've done estimates of as much as 60%. So not only are you billing them back, your usage is going down. So can you imagine all the apartment owners in the United States doing this? Water usage would go down because no one's filling their pool now, right? Because someone's got to pay for it. No one's washing their car now because someone's got to pay for it. So it's amazing what happens when people become responsible for their own usage. It just drops tremendous. It really does. It's amazing.
Have you guys ever experienced any kickbacks implementing a RUBS into an existing apartment that didn't have that in place? And how did you guys overcome that?
Well, it's just, it's one of these things where we took over a property, it was last August, and the tenants at one of the locations were really upset about it. They said they didn't want to pay it, and they weren't going to pay it, this, that, and the other thing. And you just have to be professional, you have to be polite, and just wait it out. Because it was about, I would say, 90 days of temper tantrums and complaining. But it's just, if you remain disciplined, though, it's not that we're overcharging. That's the thing you got to keep in. We're doing exactly what the market is doing, okay? So, and it's not like they're not using it. So the tenants are paying, for their rent, and then there's a utilities that goes along with it. Someone has to pay for it. So it's based on usage, keep in mind. So we're not doing something, crazy. So yes, there's been temper tantrums at times almost, and there's been, the tenants have been, upset about it, but we explained it to them. We're very professional. This is the water that's being used. It's a utility, and you just, it has to be paid for, and it's part of our program. Even with our, our online payment system, we use the AppStone, and it basically, it's on our website, enables tenants to pay their rent. It's like this. We will allow you to pay with a check for free, and it will scan it, right to the bank from the office. If you want the convenience of paying with a credit card or a debit card, we accept that. We want you to have that offer, but Yapstone will bill the tenant directly for the service charge. So I know with a debit card, it's very minimal, maybe 1% or less, but if it's a credit card, it's 3%. And so, if it's $1,000 a month, that's $30. So that's a decent chunk of change. But we give people the option, and if they want to use that service, we want to make it available to them. I think people forget a lot of times because people sometimes lump things together. If you go to the gas station, you pay with a credit card, you may just think, oh, the credit card's free. But it's really not. They're charging for that, and it's actually driving up the cost of a lot of other things. People just don't realize, and they just accept it for the convenience. So it's just an awareness, and after the first month or two, people seem to calm down and understand it.
Yeah, I think it's like Finance 101 is understanding, across 12 months, don't look at this month to month, because overall, most of the times, doing things in bulk over time does become cheaper. So that's cool. Like, you have an inverse effect of implementing this and people start using less, which, of course, for me, I'm an environmental.
And I think it's almost like an education sometimes for folks, even though it's, people don't want to pay it. I get that. But it really it makes for a more sound investment, not only for yourself, but if you're financing it, it's actually better for the bankers and everyone involved. So
absolutely. Now, the next section I wanted to, that we're going to skip over, but I wanted, if you could, Gino, just kind of give a brief synopsis of what kind of to focus on in this area is the due diligence checklist. When you guys were about to purchase this property, obviously there's a lot of research that needs to go in, paperwork that needs to be grabbed, and again, we're going to include that checklist as a downloadable document in the right below this video. But it's stuff like, collecting rent rolls, verifying income and expenses, what happened the last 12 months when it came to operating statements. But is there anything in this specific list, Gino, that people should be focusing on?
Well, Jake likes to talk frameworks. It's another 3-step framework that we have. For the guys who've been doing it for a while, they probably know this intuitively, but when you're first starting out, there's a 3-step framework you want to follow. The first part of the due diligence is financial. If you have you want to go through the numbers. You want to do the numbers first before you do anything else. If the numbers crap out, if they don't work, you move on to the next deal. No harm, no foul. Make sure the numbers check out. Once they check out, then you go to your physical due diligence, which is actually inspection of the property. Have the inspection already set up. But if those numbers do work out, go to the inspection, which is the second part. And Jake can speak to the cost of it. We've gotten it down tremendously. I mean, the first deal we had 25 units. The guys wanted $4,000 to do the thing, and it's crazy. A house inspection is about $500. We got it down to $20 per unit. On your physical inspection, inspect every single unit that you have. Make sure it's thorough. Get tons of pictures. So when you go back and you say, and that's another thing we got. We got $30,000 in credit to this deal because we showed the sellers all the problems, a lot of leaks, a lot of the deferred junk on the property, which is no big deal. We said to him, you can either fix it or give us credit. They wanted to give us credit, so that was another $30,000. Did it cost us $30,000? No, because we have maintenance guys who are paying anyway. So it might take us a little bit longer, but we got that credit. Those pictures are worth 1,000 words. They're worth their weight in gold. You can go
almost
back.
Indisputable. If you see a leak on the ceiling where it's stained, well, there's probably a leak. Right, so that's why you need those pictures, and the guy, if there's an HVAC unit down and it's not working, takes a picture of it, documents it. So the things are real. We were just wanting to make sure that everything is rent ready. That's our terminology. When we go in, we say, look, we're just looking for, if we're buying 156 units, we want 156 rent ready units, and that's the expectation going in. It's no surprises.
So say you guys have go ahead. Finish the third part, and I'll follow up with the question.
Going to the third part. Third part is legal. So most of the deals that fall out, they fall out in financial. Between 75 and 80% of the deals fall out because of the financial numbers. So financial, then physical, then the last one is legal. You want to make sure it has the proper C of O. If you're buying 156 units, it's a 156-unit multifamily complex. That's what you're buying. You want to make sure there's no liens on the property. You want to make sure there's proper title. So that's the very last one. So follow those 3 steps in order, and you should have a pretty good due diligence process.
Absolutely. And the question I had for you guys is, when you guys were going through the vacancies, or oh man, I think I lost my question. Let's come back to that.
Sorry.
No, it's okay. It's all right. I have tons of questions, as I'm sure the people who are watching this do too. This is great information, and I hope you guys who are watching it leave us comments. That's one thing I forgot to mention, is that Gino likes to participate in our YouTube videos. I really appreciate that. So leave your comments below in this video, and I promise you, Gino will get out there and answer them and interact with you. So that's part of the fun in this. So let me look up here real quick what I would like to, which is our, and let's see here, logos, day of, garbage. No, let's not talk about that. Discuss problems that occur. Okay, so what kind of problems do you guys experience going through this first stage of due diligence? Just kind of get things started. You said having repair costs that were larger than your capital repairs. Leases that have concessions that were built in. What were kind of some things that people should be aware of when they're about to buy a complex, other than the 3 things that you just mentioned, Gino?
Go ahead, Jake. You take this one, baby.
Man, we've seen it all. I mean, I can even take you back to our first deal, and this should have been a deal breaker, and it probably was. That's why it sat on the market for so long. Our first 25 units, the owners actually commingled all their rental properties in town into one bank account. So when we said, okay, we like the property, they gave us numbers. It wasn't chicken scratch, but it was definitely put together by the broker. And when we asked for a proper P&L, it didn't exist. And so we started saying, well, let's see the bank statements. Well, the bank statements were a lot higher on the income than what they're showing us. Okay, so for a second you think, well, that's a good thing. Well, no, because there's multiple other properties lumped into that bank account. And then we're like, let's see the tax. Same thing with tax. Everything was lumped, right? So the problem with that is they didn't really know. They had an idea of how much the property was doing, but they didn't know. So, and this was a mom and pop owner. And we like to focus on the mom and pops because it provides opportunities. Today we have no money left in this deal. We fully cashed out of it, and we're cash flowing $3,000 a month on this little 25-unit property. And so it was well worth the time. But what we did is we went around door knocking. We didn't know what else to do, so we wanted to make sure there was basically live bodies in the units, and the owner was fine with it. I said, I need to verify. I trust you, but I need to verify. So we went around and door knocked 25 units. People were in each unit. I said, just tell me what you're paying. And I wrote it down, and it actually all checked out. And they turned out to be fantastic, honest people. They just weren't the best business people. And even before closing, they wanted to make sure that the closing went through. They replaced a couple of roofs. They did a bunch of painting. This is the week before closing. If they would have done that months ago and then marketed that, they probably would have sold it. So you just never know what you're going to run into. It's always trust but verify. And we've run into a million things. I mean, we almost lost a deal because the guy didn't want to fix a few broken windows. Remember what I said before? We want rent-ready units. I said, look, this needs to be fixed. We talked about this before we went in. He said, I'm not doing it. And it would probably cost us, less than $1,000 to fix those 3 broken windows. This is another fantastic deal. We've refied all of our money out, same thing. And it would have killed me if I would have lost that deal for that. So sometimes you need to be disciplined, but you have to look at the bigger picture and say, is it worth it for $1,000? And that's what you have to ask yourself.
Frank, to go back to your question, the other thing is get every lease, do a lease audit. You want to make sure if you have 30 leases, every lease is what it says. Make sure they have a $500 security deposit. Make sure they're paying $500 a month, and make sure Uncle Louie is not in apartment 32 with a 6-year lease paying $200 a month.
That's big.
Whatever you get, you're going to assume that lease. It is a legal document. You're going to have to abide by that lease, so you're taking it over. So that's really powerful. You really need to know what's going on with those leases. Jake was talking about the first deal we did. Those are weekly renters. I mean, that was just a tough thing to do. We saw the income was greater, but weekly renters is it's a different animal. It's a different beast. Fortunately, I knew that we had to go to monthly renters because they're more stable. Turning an apartment is one of the biggest expenses, losing that. And that's what happens to weekly renters. They're there for 3 weeks, then they're gone. You got to go back in, you got to clean up, you got to paint. It was just a difficult scenario. So you have to know what type of tenant base you have. So this property we just bought, there would be tenants. We don't have to deal with that kind of situation. But we looked at every single lease. You have to look at every single lease. You have to go through every single apartment, make sure that you're getting all the appliances, get the warranties on everything, make sure, everything is transferred over to you. Jake got his nice little golf cart there. I didn't get a golf cart, but Jake got a golf cart there. That ain't fair.
I'll send you a picture of that too, Frank.
Everything's coming over to you, make sure that, the contracts you get, you're not locked into a 7-year garbage contract because then you're locked in. The cable contract that we talked about, we bought a property prior to this one that had about $25,000 worth of cable money left on it. That should go to us. But we did not lose the deal. They didn't want to give it to us. They were adamant. So I said to Jake, are we going to get that cash flow back in 2 months and not worry about it, or are you going to kill the deal because of 25? So try not to be short-sighted. Most people with their ego would have said, that's it, I'm out. But we just said to ourselves, it's foolish. Why would we take that risk and that, just to kill the deal for that? So you're assuming everything that's going on with the property. So make sure you're diligent about everything, all the aspects of it. Pool contract, landscaping contract, the pest contract, make sure you go through all of them. And you know what? You might keep a lot of these guys. You might renegotiate their contracts, but make sure that you're not assuming them long-term.
So 2 questions to follow up, and I did remember the one that I was going to ask before. Thanks, Jake. You actually spurred that thought back. But first question is, oh, man. It's like these brain farts are coming through, and I just can't stop them. So I'll remember that question. So when you guys are negotiating the property and you say rent ready, say out of 156 units, if, say, 10% of them, they're just older, air conditioning units or things like that, you want them to repair these things, correct?
The things that rent ready is basically the dishwasher's functioning properly, the oven's functioning properly, the stove, everything's working, the AC is working. Guys, let me call a quick timeout here. I got to get this. Somebody came to my door. I got to shut it off. We're gonna be okay, right?
Yeah, we'll be okay.
I don't want to. Give me 1 second. I'm sorry.
I'll continue with that thought. Let me continue with what he takes care of his pets. Tennessee pets. You want to be able to take over that unit and say, listen, I can put a tenant in next week. Now, I'm not talking about like the beautiful cabinets and granite countertops, but you want it functioning. And one of our properties we took over, 136 units. There were 6 or 7 units they were using as storage sheds, maintenance. I mean, it was just 6 units that were downline, they were offline. We said to them, we need flooring. We need them to be at least rent ready. Now you might get pushback, but I mean, let them push you back. That's something that we want because we want to at least be able to have those things rented out. And I don't think that's something that is a crazy thought. I think people should have that done, basically. So, I mean, on 136 units, you have 6 units down. At $600 a month, that's $3,600 a month. You're talking $40,000 a year in rent. That's just done. They're just too lazy to actually see what's going on. They're not running it as a business. So
I'm really sorry about that, guys.
That's okay.
That's all right. Welcome back.
You actually have to make that a rent-ready situation. You want that. I mean, like I said, it doesn't have to be done to the gills where you have this granite countertops, but you want at least to be a shell and actually have countertops and refrigerator and stove and, like Jake said, the rest of the stuff in there and flooring. Like I said, you can't take an apartment over like they had. Remember, Jake, they had 6 storage units on one property. I mean, that's crazy. That's insane.
Because the reason I ask is, as investors, you're going into it, most of the time when you're dealing with residential, you're buying properties as is. How much flexibility do you have with commercial? Like, oh, okay, it is a broken window. Am I willing to let this deal go down? Say I'm dealing with the 10 unit. Just a couple of windows are really old. Am I letting it go down, or do I want them to replace it? What are you looking at to make that decision? Like, okay, I'm going to let the windows go, or you need to fix it.
If it's not working, if it's not performing properly, right? If the window's fogged up, how the windows get at times, where the seal's been broken. Yeah. Yes, exactly. Then I'm asking for it. Okay. Then that needs, because that's not proper. It's not the way it's supposed to be. If the refrigerator's not working, we're asking, we're adding that in. At the end of the day, though, everything's negotiable. It's real estate, right? So you get as much as you can, and we try to be fair. We're not asking for things we're just asking for rent ready. That things are operating the way they should be. If they're not, people may push back though and say, no, I'm not doing that. And then it's up to you how bad you want it, how good is the deal for you, and that's going to be a game time decision.
See, Jake, just so you guys know, Jake was a sales guy before, so he has no shame.
No. Sales guy for life. All right.
Sales guy for life.
That's right.
So you guys ever need he's a deal assassin, so if you guys ever need to figure out how to get things done or negotiate and creatively finance something, Jake is your guy. So we'll give you a way to contact Jake. So the second question I wanted to follow up with is, of course, you guys, 25 to 150 is a huge difference. Are you guys personally reviewing each of these leases, or do you guys have an attorney you send it to, or how do you guys go through 156 leases?
We did in the very beginning. It's part of your business. You have to do it. I mean, we started out with 25 units. From 25, we went to 36. From 36, we went to 136. Then from 136, we went to 24. Then from 24, we went to 281. Then 281, we went to 16. Now we went to 156. That's the whole gamut. And every single one of them, you're responsible. Because when you buy something, you assume it. So, I mean, it's really weird when you have a partnership. You're willing to do more for your partner than you are for yourself. That's one of the great things about partnerships. I mean, you're willing to take care of your partner more than you are yourself sometimes. So when I want to buy something, I want to make money for his family and for my family. But ultimately, I'm going on that extra yard. I will look at all the leases because it's really important. And, it's only a couple hours. If you get them all at one time, you just put them into a spreadsheet. You put name, when they expire and all. It's not really that difficult. It's a little time consuming, but it's well worth going through.
Worth it. And Gino's found some Uncle Louis in the past. Let me tell you what, haven't you, Gino?
Well, you got.
What are Uncle Louis?
Okay, the 136 unit property we bought almost
Uncle Louis.
We had 3 cops on the property living. 2 cops were on there for free, and 1 was paying half the property. So to me, that's an Uncle Louis. He's getting the bargain of a life. There are a lot of family members. All of a sudden, you have aunts and uncles on for a little bit longer, or they're not paying anything.
$100 a month in rent. Yeah.
Yeah. Or you have Joe who's cutting the grass. He's getting a great deal. You have Bob who's cleaning the breezeways. You have Lucy who's doing some work. I mean, that's how people run the property.
The best one for that was the 281 units. They had the lady that was cleaning. They had the uncles. They had the aunts, the brothers. It was a total mom and pop family run business, and there was probably at least 5 Uncle Louis on that one.
I mean, that's a lot of money you're talking about. So
they're all discounted, like $100 a month or something crazy.
You have to make sure that lease isn't 5 or 6 years because you're assuming it. So you know what? They know the end of the rainbow is coming. They just know it because they've been living off the hog, and they know that once you take it over, that rent's going up as soon as their lease expires. That rent's going up.
And they know the lease, and they know exactly how much they're paying, and they know how long it is, and they'll ask, "Can we get this extended right before close?" So you got to be very careful on that.
So to my understanding is the agreements prior to you guys taking ownership, do those carry over, or do you guys are able to renegotiate those terms? Or do you have to wait?
That's what we're saying. Yeah, you have to wait. If it's a 10-year lease, you're buying that lease. So you got to be careful. Yeah.
All right. And just so I know, and I'm not super familiar with this, is on average, is that very common? Or
no, but that's why you're just watching out for the Uncle Louis, because you don't want an Uncle Louis. Because then if the guy's a pain in the butt too, this, that, and the other thing, you just want it to be, what they're typically doing. If they're doing 12-month leases and the market rate was $700, then that's what you're looking for, making sure everything checks out.
So you guys say that, like, say out of like a 50 unit, say 95% are paying what they need to, and you have the 5% or even 2% that are Uncle Louis. You just got to bite the bullet and deal with it until their lease is up?
That's right,
pretty
and that's
much.
one of the value adds. What's great about it is Uncle Louis is not showing up on the income, so the income is less, so the NOI is less. So we know 6 months down the road that rent there's 2 cops were getting for free. That rent's going up to market, so that's another $1,200 for those 2 apartments. So that's what's great about it. Those are the value adds that people don't see or say that's a problem. So a problem in life can be turned into an opportunity. So down the road, 6 months down the road, that problem is going to become our opportunity because we're going to be able to.
Yeah, Uncle Louis aren't bad as long as they're not locked in for long term.
Yeah, and they're usually not.
What's the longest term that you guys have seen?
I think we saw like 2 or 3 years on the 281 unit one. It was like a 2 or 3 years. It wasn't crazy. Yeah, there's nothing, but I don't know. I feel like we've heard like horror stories from other people that we've networked with before where they've got like a 5 or 10 year and they've had to address it before closing. So I don't think we've seen anything for more than 2 or 3 years.
What does it even take for someone to agree to or even create a plan? I wouldn't even do it.
It's like an aunt or an uncle or a family member. Okay. And that's why we're saying, and that's usually what it is, especially with the mom and pop stuff that we typically buy. They'll have literally their family members living in these units at a serious discount. So
I would love to move on to this one thing. I know we've been talking about like raising rents, add values, kind of ways to really increase your NOI. It's kind of the exciting parts of commercial. Let's get into some of those details, the specifics to kind of what you guys did to the property that you guys purchased. I know you guys have made some updates to the signage. The clubhouse, you guys are adding a fitness center. I know you guys are converting is it an old laundry or are you guys creating a new laundry?
There's 4 laundry units on the property that are very large. They're actually the size of 2 bedrooms. And what we're doing is we're going through is we're updating the units because a lot of them have washer dryer hookups. So we're adding more washer dryer hookups, and then we're basically getting stackable units into the main laundry. So we're going to be able to condense the laundry into one location and turn those other laundry mats, if you will, into flats, which are just regular garden apartments.
So what else? Apartment. Did you guys do anything actual to the physical units themselves?
Let's talk about that because there's something we like to call it modern affordability because we're buying B and C apartments and we want to be able to keep the price very competitive. What we do is we go in with a 2-tone paint scheme. That's one of the first things we do. We love paint just to freshen things up. We use a modern paint scheme. We'll do nice white trim on the baseboards, on the doors, and then we'll do we won't whitewash everything. We'll either use a really nice like cafe color on the walls or a light gray. Okay, the millennials love the gray, the pewter.
Yeah, they do. It's very modern. Yeah, very modern.
And then what we'll do is we got this really great guy, Surfacing Solutions. They go through, and they're actually able to take the old countertops, resurface them, it gives them this almost sheen to it, and they look brand new. And it's roughly $250 to $300 per, which it saves our guys time because they don't got to go in and rip out countertops, order them, cut them, get everything done. So you're taking these old Formica countertops, you're basically refurbishing them, and they have a nice glaze, and they almost look like a stone. So that's one thing. We love to paint wooden cabinets. So we'll go in a lot of times. We'll paint these ones. We're actually painting black, and we got this lighter color white with black that comes through like speckled throughout. So it looks really great. And then we're doing the finishing, the hardware on the cabinets. Well, every time we go in, it's a judgment call on the appliances at this complex, and it's just the new ones that we're going into. If it works, we'll run with those. And then a lot of times we'll replace the lighting fixtures. I love Lowe's for lighting fixtures. A lot of people, when they get started, they worry about SKUs. Like the number, I get this one from here and that one.
Right.
You can't get too caught up in that because a lot of times there's a fairly close price point. You don't want to overpay. Trust me, I don't ever want to overpay. But I think for value, we definitely like going to Lowe's for light fixtures because you can find some really cool track lighting if you look hard enough for like $20. The other thing that I really like doing is there's these outlet for the plugs, the electrical plugs that you can they go right over. You just screw them in, and you don't actually have to replace the whole plug, and it turns it white. It just is a white plastic cover right away. They can plug into it. And for the light switches, it looks like a dimmer, but it's actually just goes right over it. Yeah. And so these are really affordable things that we do to go in, and it makes the whole apartment more modern and affordable. And, it depends. The flooring is a judgment call. We like to go with the wood look vinyl. We're not replacing carpet if it doesn't need it. We'll go with a carpet cleaner. But, the things that we do, though, we'll take. There's only so much you can do to these units. The biggest thing is going to be paint and the trim, getting it looking good, and we'll do the best that we can for the kitchens and the bathrooms, and we just make sure it's very, very clean. That's one thing that I really harp on with our other teams. I really want things to be clean and crisp. So,
and you're doing this only currently to the vacant properties first, right? Or the vacant units first, and then as soon as someone moves out, you're like, let's turn that one around, and then you're never really doing it to an existing tenant unless they maybe ask for it or...
Correct. You know, if someone comes in and asks, then it's like, okay, well, if they want to move, say they're paying, a great example is one of the complexes we took basically from $450 to almost $635, $650 depending. It was almost a $200 increase in rents. If they want to move into one of the newer units, by all means. And then what we'll do, we'll move you in at the new price point, and then we're going to go in and rehab your unit and do the same thing.
That was my eureka moment. My eureka moment was when we had the $450 a month. All of a sudden, the lady loved the whatever we did to it, and she's like, "Can I move into it?" That's great. So we're adding value. We're going outside. We're power washing the building. We're painting the exteriors. We're taking care of the driveway if you have to seal or stripe the driveway. We're changing the mailboxes. We're doing all that value on the property to be able to compete with our competition.
Such a great point, Gino. It's such a great point because people may be listening saying, "Oh, I can't do this. I can't raise rents. I can't do this." We've actually had people saying, "I want one of those. That looks cool. Give me some of that." So,
wow, there's people willing to pay more because they're getting a better. It's just like anything else in life. If you're getting something better, it's the appearance of a value. It's not price versus value. We always focus on price. Sometimes you have to focus on value. Price is intermediate. It's a short term. Value is long term. So they're going to be living here for the next 12 to 18 months. So is it worth it for them to spend another $100 a month? To some people who are cheap, maybe not. But some people who find value in living somewhere nice and clean and better, they find value in that, and that's what we're trying to accomplish.
And I think I get a lot of feedback from our students, and it seems like commercial's always been propped up as you can make money exponentially, but they never really focus on the add values, the things that you can do to really increase your NOI. So if you're watching this, guys, commercial is a great opportunity. But if you're thinking about just buying a unit, just going in and just continue the same type of management before, you're going to get the same results. If you're trying to scale up, you want to go from the 15 to 25 to 50 units. These are the type of things you always need to be thinking about, and some. Like the stuff that Jake and Gino do, not every single person who in commercial does these things. There's a good portion of them that do far less, and then their results are far less than theirs. So it's really important that you guys are hearing these add values that they're doing, because these are pro tips. These are things that not everybody knows how to do. So I just want to bring attention to that real quick.
I want to touch on that more because it's just, I'm sorry, start feeding off your energy, and it's like,
of course,
we call it the death spiral, because that one property we were talking about that they were renting for $450, her business plan was, if I don't fix it, but if I only charge them like $450 a month, they're not going to call me. Right, so the property deteriorates and keeps going down and down. But she's like, well, they're not going to call me though. If I only, they know if they start calling me, I'm going to raise their rent or something. I don't know what the craziness is, and it's just think about it. It's business. You got to keep innovating. You got to keep moving forward, or you're going to start to fall by the wayside. So you got to be constantly looking at what are the trends. What can I do to raise my game up and improve my my game and make it better for my tenants? And that's the mentality you have to have, or you fall into the trap of the death spiral. You get lazy, and then we can come in and hopefully buy you out for a good price because we buy in actuals. So
there you go, guys. If you have an apartment that needs help, there you go. The apartment rehab.
JakeandGino.com. Give us a call. Right?
There you go. There it is. So obviously, when it comes to apartment, you're also dealing with a clubhouse, which means you have people showing units, you have people who are collecting rents. Are you using the existing staff, or do you just do an overhaul because you have a system in place? How do you?
I like to give people the chance, and I definitely interview them. It's just, for me, it's all about people. The reason we have these great, and I think I've said this to you before, Frank, we took that one unit we were just mentioning, that one complex, so it was doing $50,000 a month. We do over $90,000 a month consistently now. We took one complex doing $140, we're doing $180 a month now. We are very much engaged and treat it as a business, and we're very hands-on with our folks. And it really, at the end of the day, it comes down to income versus expenses. So we really look for talent. I'll give you an example. We were at a little personal store. Gino and I, with our other partner, we were with Chris one night having dinner with a banker, looking at this deal. The waitress was phenomenal. Had it. Customer service was on top of it, And we're all sitting around joking like guys. I'm like, man, I think we should hire her. And they're like, are you kidding me? She's gonna think we're like hitting on her, all creepy and stuff, right? She's turned out to be a rock star. She's actually brought her onto the team, and she's just killing it. It's going out there. Yeah, it's great, and it's just finding those people that have it. When you speak to somebody and you see that they have that customer service, you see that they're engaged, and sometimes they just need an opportunity, and that's what we look for. We hire on attitude and ethics, and then we really go into the training of it, and we just try to bring on really great folks, and in turn they make our business better, and it just raises these little communities up, and it's like this snowball of good. It just keeps rolling, man, and it's really incredible.
That's awesome. I love hearing stories like that, and I'm glad you guys seek out talent as just a restaurant server now works for you guys. I think that's awesome. Let's see here. I wanted to briefly talk on something real quick, which was basically the takeover process, and maybe Gino can give us a quick synopsis like how you did before the 3 physical, financial, and then legal. When you guys take over a property, of course, when you're under new management, notifying your tenants, what are some, what would you say are the core things that investors need to focus on when you're the new managers now? What are the first steps that need to be taken so your tenants will know that you're here? What needs to happen?
Sure, I'm guaranteed I'm going to miss a few things. I'll let Jake follow up.
We have a checklist for this as well. So we'll include this in the bottom as well. Again, we have each of the things we've talked about has a checklist, so we'll include that so you can really go through. This one alone has 22 things, but I just want Gino to cover a few.
Yeah, sure. What happens is you get that energy, right? It's almost like a drug. It's so addicting. It's like me having kids. The more kids I had, I keep having more
Gino's
kids.
got 6 kids, by the way, if you guys didn't know that.
It's like buying property.
That's a lot.
Because you get better at it. You really enjoy it. You find what you want to do. So for Jake, 2 months before and after the takeover, he's super busy. You got to get in touch with the bank. You have to set up your checking account. That's probably the most important things. You have to get those takeout letters to the tenants because you want to introduce yourself, saying what's going on with the property. You're buying it. You're saying this is what you want to do. You want to make yourself known. Utilities have to come out of their name into your name. You want to get your teams in place. First day you take over, you're there up and running. So you have to be on the property. So a lot of stuff going on. There's a lot of energy going on. It's exciting because you're taking something over. It's a new thing, and it's just so much going on.
Yeah, you got your new marketing coming out. You got your new branding of what you're going to do. You got to line up your contractors because, look, these guys they get busy, and you got to get ahead of the curve because if they're booked up and the good guys, because listen, one of the hardest things to deal with in property management is the contractors, especially when you're going through a repositioning, and there's only a handful of them that you really can trust. That, in my experience, I'm sure there's tons of great guys out there, but we get a comfort level with certain folks. We want to really use them whenever possible. So you want to get ahead of it, get them booked, let them know what the scope of work is, start getting quotes. You want to get 3 quotes for every job, and just starting. It's really about getting your ducks in a row. It's lining up. There's so many vendors that need to be transferred, and make sure you're communicating with all of them. And then it's your messaging to the tenants, letting them know, look, this is what's going on. Telling them this is what's come in, and these are the things we're going to be doing, because you don't want people think, oh my God, the price is going to go up immediately when someone buys something. That's the first thing they think of. So we address that, and we say, look, you're under a lease. We're going to be doing some things to the property, this, that, and the other thing. As things like inflation goes up, obviously rents tend to go up, but we're not looking to hit you right now with any kind of rent increase. So and you can't. If someone's on a lease, that's what they need to understand too. That's a lease, that's a contract, so they're tied in for the remainder of that lease. So there's a lot of things that go into it.
Now, do you guys generally, you set up all brand new services from the previous, I'm sure, if the previous owners had, rent collecting software or, any type of way or CRM to kind of manage their property, do you guys just use the existing one, or do you transfer it over to your?
Yeah, and that's part of our underwriting too, because we know what the previous people were paying for expenses. We know what it costs us per unit to run our business and comparable, other properties that we have. So what we do is we actually incorporate our current team. If we got a great painting crew and they're knocking it out of the park for us, we want them to get that increased business, because the more business we give them, our price should be going down. And that goes for everything. So we really, we use RentPost for our you can go to rentpost.com and check it out. It's super affordable. It's a newer software that came out on the market a little while ago, and their great thing is that they're all about ease of use, because you can get into some of these things out there like Yardi, and Yardi's great, But when you have to bring on new people and you're growing like our company is, sometimes the training that goes into a yardie can be very complicated. And so we're able to bring folks on, get them ramped up quickly, get them using the software. And for me, I'm not a tech guy. Like it's a miracle. I always say that whenever I'm on one of these calls, it's a miracle I'm on this call. I can even get on right now. I can barely figure out my cell phone half the time, right?
Right.
So I want to be able to get the report, and I want to be able to get in and read it and look at the rent roll and know exactly what's going on. And so that's why we've really enjoyed using RentPost. But we really, like I said, we will interview the current folks there. If we find someone that's a rock star, we'll bring them on. But we're definitely incorporating our systems and our teams when we go into these things.
So RentPost for rent. I see here in my notes you use ADP for payroll.
We use ADP for payroll, yeah.
Okay, and ADP is an acronym or the actual like ADP.com or
ADP.com, yeah. No, they're for payroll. They're I think they're the biggest.
I use Paychex also, so Paychex is another service. And you know,
it's a Rochester-based company.
Another thing you can do is if you have a bank like Wells Fargo, a lot of these banks have payroll services, so you might be able to bundle the whole entire thing, get a little bit of a discount since you're using their checking and banking. So look into a bank that does payroll also. But I like ADP. It's online. It's really simple to use, and I've been using it for my business also.
And we mentioned Yapstone before for our online payments. We use Yapstone. We got a great guy to develop websites. You can check him out at alloutsolutions.com. He builds all our websites out for us. I'm trying to think of the vendors. What are the vendors out there that are important?
You need video. Well, you need great videography. You need somebody
great video, great pictures. Yeah.
When you get onto the website, that sells the property. You want videos. What we want to do right now is I want to start implementing videos on our site with our managers, our leasing agents, saying, hey, this is Jake and this is, the Hammond. We'll welcome you here. So you want good video because video sells. That's what's going on right now. And you want great pictures. So it's important for you guys to set that up.
And I can't wait to share the signage. I think, when you see the before and after.
Sweet.
Yeah, it is. And I think the way you guys updated the name, just something so simple, but when you guys see the old sign versus the new sign, and then they're pretty much embodying the entire complex after that new sign. That's the general feeling that I immediately got when I saw it. And it's exactly like the ones you see, like the Riata or things like that, like where they're really, really, really nice. But this used to be a mom and pop apartment. Yeah. And it's amazing what the branding you guys have done, how much, we use the word add value quite a bit, but what you guys have done to this property. Now, just to give people a rough idea, we've talked a lot about, what you guys have done to the property. What did you guys mind me asking, what you guys purchased it for and what the anticipated value of it is in the next 5 years? Is that a safe number to reference?
We purchased it for $7.1 million, and the financing was great. Everyone says you need 20% down. We put 15% down because we've got a relationship with the bank. They knew the numbers were great on the property. We got 12 months interest only. I mean, how awesome is that? So we're basically all the principal. You could either do one of two things. You can either redistribute the principal you're not paying, or you can put it back into the property. We're probably going to redistribute it. And I think at the end of 12 months, we're going to be able to have that revenue up so much that we're going to be able to reposition this property, refinance the property out, pay that loan, and move it over to a Fannie product. Right now, it's a 25-year amort. It's Jake, what's the rate? It's like 4.25.
4.25. Yeah, we can probably move it up and out to a 30-year AM, probably about 4%, depending where rates go. But I think that in the current environment, you should be able to get about 4% in the secondary market. And the beautiful thing about that is then it goes non-recourse, so it comes off our books. So we love that aspect of it as well.
And so the anticipated value, you guys would say, even in the 24 months, what do you guys think?
I think we're definitely within the next 12 months we're going to 120,000 on this thing, and maybe we'll be looking at like 70,000 in expenses per month. So I mean we're gonna be really knocking it out of the park.
I think it's worth about $9 million. I think $9 million is a safe bet. And the funny thing is, we're riding the wave right now. So everyone's complaining that there's no deals. You find a deal, what's going on? Cap rates are coming down. Price is going up. So we're riding that wave on top of the forced appreciation wave. So you can see people get into it now because the market's still emerging. I mean, rents are still going up at 5% a clip. Occupancy over the U.S. is over 96%. So the market's still there. Millennials are there. Every 7 seconds, you got somebody who's turning 60 in the United States. So the demographics are there for people to rent. People are not buying homes anymore. They're renting. So I can see what happens. There might be bumps in the road, but there's still going to be a demand out there. I'm renting. I never thought in a million years that I rent, but it gives me the freedom to come to Florida, go back to New York whenever I want to. So I don't have to lock myself in. And millennials are going to become independent contractors. By the year 2020, about 50% of the workforce is going to be independent contractors because you can't afford Obamacare. You can't afford all these kinds of things. So it's unfortunate. You don't want to say it, but that's what's going to happen. You got people working on CrowdSpring, Fiverr, and it's good and it's bad because they have the ability to live wherever they want. So if you want to live 12 months in Knoxville, then 12 months in California, you can do that. 6 months overseas, you have that option. But what that does is it creates a demand. You have sites like Airbnb, VRBO, PadMapper, all these sites that are catering to that. So what does that tell you? Look at the market, see where the market's going. People love these short-term rentals, and if you have a complex like we do, you cater to them because you can charge more per short-term rental. So you have to see where the market's going. But this is what I'm seeing is driving multifamilies right now. People aren't buying houses as much as they used to. It's not the American dream anymore. We bought into that until 2008. That when your house falls 60% of the value, you were able to refi it or take out the equity line. I mean, I fell in that trap also. Home ownership is not cracked up to what it used to be. You're not going to create the equity in your property going forward as you were able to years and years ago. So that's one of the deterrents, I think, of home ownership.
And that what you said there covered a lot of important points there. And I think, we live in a society now, and even for us, a lot of our members are interested in wholesaling, flipping properties, and things like that. And depending on your market, and that's why we always tell you it's very, very important to really expand your investment portfolio, not really pigeonhole yourself into just one specific strategy.
Those are not wealth creation strategies, though. I mean, it's great if you want to utilize those to get into bigger deals, but I mean, our whole goal was to create passive income and build wealth, and that's why we are in multifamily investment properties. So it's I think people, especially when they're getting started, they have this big plate in front of them. They can say, I can flip, I can do rentals, I can do this and that. And there's a million ways to make money in real estate, but what happens, they get caught up in it, and then they lose focus because there's so many things, and they're like, I want to do this, that, and the other thing, and the flipping is like really cool. It's on TV, and you got this guy in Las Vegas that yells at everybody, and you can do it, right? And it's like it's very attainable because everyone's like, I know houses. But the problem with it is it becomes a very long job process, and you're basically working another job for yourself. And people make a lot of money doing it. It's great, but the reason we love multis is because it's for the long-term wealth creation. And I think that's the biggest difference.
Exactly. No, we always tell people, and I think we're sending out some emails this week, just letting people know, like, yes, flipping is great. It's a great way to build capital, but it's what you do with that capital next. If you keep turning up the capital,
it's a starter.
Yeah, it's a starter. But again, like Jake said, it's something that you have to continuously to build on and do. It's harder to scale. You can, but again, it still involves you to do a lot of that work. Of course, multifamily, you put a lot of that effort in the first few years and kind of just let it percolate, right?
Yes.
So it's really the mentality of the thing, and I really want you guys to, if you're on here, you're a newer investor, you don't have to do 156 units. That can be incredibly daunting at first. Multifamily is 5 units or more. You can even do like a small 10 apartment complex, and all the things that we talked about today can be applied. And the results you'll get will more than likely be very similar, right? Just not on a much huger scale.
Hey, you got to make it happen. You got to put the work in, though, right?
Exactly.
What happens is you start getting better at it, and you see it's a unit complex. You'll start seeing things that are going wrong with it. You'll start picking up on it, but you got to get out there. You have to start analyzing these deals and looking at it and really become specific with your market. Like up where I live, we can't cash flow in New York. You just can't cash flow in New York, so I can't do that business. I could probably wholesale and make money wholesaling. I could probably fix and flip, but the fix and flip is market specific, and it's timing, market timing. Everyone's making money now. The cab driver's telling me that that's when you know that something's going wrong. When the waitresses and cab drivers talk about real estate. So it's difficult. You can make money there, but it's not what you make, guys. It's what you keep. Just remember that. Keep that in mind. You can make $100,000, but if you're taxed at 30%, you're only keeping 60 of it. With multifamilies, we can cost segregate. There's certain things you can do, the depreciation. There's a lot of ways you can shelter that income legally and keep that money. So that's what the goal is. The goal is to keep as much as you can. You can do 1031 exchange, roll it into a bigger property. So there's a lot of stuff that you guys can do to defer your taxes. We refinance the property. Once you refi a property, we pulling that money out tax-free, cash-free. So there's a lot of strategies that we employ that actually help us create that wealth.
And that's a great point. I want that everybody on the call today, we're going to give you an opportunity, and I want you guys to get in hold of Jake and Gino, and that's really the purpose. We're going to be cultivating this relationship with them. We're going to be doing more calls with Jake and Gino. They're one of our premier commercial guys right now who are doing deals, who have some really cool systems in place that I love to get updated on. So with that being said, I want to first say, thank you guys. We've had a wonderful call today. We've covered a lot of great information. Again, those checklists are a lot more thorough than what we covered today. Again, there's a lot, and I didn't want to take this a 2-3 hour call. So be sure to download those. You can follow along as we're going through today's presentation. We're going to include the pictures of before and after, kind of give an idea of kind of what to look for when you're looking at apartments. And of course, most importantly, if you guys have any specific questions, do that. Leave the questions below in our comment section in our YouTube video, or we'll give you guys a way to contact Jake and Gino. How do they do that, guys?
Number one, this is it. Snapchat, Jake and Gino. That's the handle.
Cool.
Jake and Gino Instagram, Jake and Gino Facebook. Google Plus is dead, but we're still there. So JakeandGino.com, and you got to check out our book, Wheelbarrow Profits, Amazon #1 bestseller. Buy right, manage right, and finance right. Book is awesome. I think everyone will really enjoy it. So
absolutely,
you can email us. Gino at JakeandGino.com, Jake at JakeandGino.com. So we're out there. YouTube. So.
I think you guys got the branding down. I think I think you guys utilize y'all's names very well. It works. And that kind of rolls off the tongue. I really like that. So again, I want to thank you guys again. This has been wonderful. I'm sure you guys are still doing stuff to the current property, right?
Oh, absolutely. Yeah. We're actually the aluminum fencing's getting put in this week. We got the deck stain. We went with the TWP. Supposed to be really good stuff. And the fitness center is still, we're about halfway done with the rehabbing of that. So it's ongoing. The awnings, I think, were completed probably today, so I'm heading out there after this, and maybe I'll send you a few pictures, Frank. Send you some more.
Absolutely. And what I would love to do, guys, for you is, if you guys leave something in the comment letting us know, maybe if you want to cover a more specific, Jake and Gino and all of us covering a more specific topic, maybe the RUBS program or anything along the lines of how to buy your first 10-unit apartment, complex, let us know. I know Gino will be commenting, letting you guys know how we can participate, and we'll make sure we get that set up for you. Our goal here is to provide as much content for you as possible so you can go out there and do more deals and at least increase your bottom line just by a few percent. That makes a huge deal for all of us. So with that being said, I want to go ahead and bring our call to a conclusion. This is Frank Chen with REIClub.com, your link to creative real estate. Be sure to sign up for our monthly newsletter so we can keep you up to date when videos like this are posted, or anytime new information, special offers, what's going on, the most up-to-date stuff going on in the real estate community. We're here for you. Again, that's REIClub.com. This is Frank Chen saying thank you guys so much for tuning in. Be sure to check out our other videos. We're sure that post that right after this. Check them out. We have other interviews. We have other 5-minute interviews covering all types of topics. We have hundreds of videos. So do that. We look forward to talking to you next time. Take care, everybody. Bye-bye.
Thanks, Frank.
Bye, Frank.
Amen.
Thanks, everybody. What's going on, guys? Frank Chin here with REIClub.com, your link to creative real estate. Today, I got a quick video for you covering the 4 basic types of deeds and how they differ from each other. Today, I got a quick video for you covering the 7 tips to submitting a winning real estate offer.